We have this incredibly bloated financial sector. It's a phony crisis. They don't have to be cuts. We know how to get out of a Great Depression. You spend money. If we take a look at the typical worker, they're not doing fine.
Hi, I'm Dean Baker. I'm your host on Mostly Economics. I'm happy to have with us today Amy Hanauer, who's currently the Executive Director of the Institute on Taxation and Economic Policy. And before that, for many years, she was the founder and executive director of Ohio Policy Matters. And I'm going to say a little bit about that because Ohio Policy Matters is one of these great organizations, tiny budget, and they were very much involved in a wide range. I shouldn't say history because it still goes on even without Amy as the director, but it's very much involved in a wide range of economic, social policy issues, things like childcare, living wage in Cleveland. I can't go, I could take forever going through the list of all the things they've done, but I just think it's very impressive. I'm saying this partly to praise Amy, but more importantly, I think it's really, people have to recognize sometimes that someone who spends, very determined, very smart, picks their battles, they can have a very big impact. We see all these clown show lobbyists in Washington, D.C. with millions and tens of millions and this and that. They had that in Ohio, and Amy was able to counter a lot of that by, acting smart, basically, and people should know that. So it's the sort of thing we should all take encouragement from. So welcome, Amy.
Yeah, thank you. And I'll jump on the Policy Matters Ohio praise because we have we did really cool work for many, many years. I was there for 20 years, but the work goes on with an amazing new executive director named Hannah Halbert. And, they've taken the organization in some new directions. It's really closely linked to movement building in the state. And, as you say, you can have state policy is really important, and people sometimes get very focused on federal policy as well. They should, because that's really important too. But we're seeing some really creative and positive and amazing things going on in tax policy in the states. And we're seeing some awful, horrible retrenchment in states. And it's going to mean divergence in what states can do for their people. So, support your state groups.
Yeah, no, very much. And Ohio Policy Matters really is a leader, but, there have been other state groups. I won't go into all of them because people get pissed at me at the ones I don't mention. But, it's a case, it's something, I've come to realize. I went to thought this probably 30 years ago. But very often what you find is that you have sympathetic people in legislatures who literally just need the information. So that might sound hard to believe, but it's not like it just comes to them from God. So a group like Ohio Policy Matters goes, yeah, we could raise the minimum wage and it won't create unemployment. We have all this good economic research that shows that. And that can make a really big difference. Again, they make a big difference. Other groups have. So anyhow, that's a bit of a digression, but people need to know that.
Yeah, amazing. So, yeah. And so now I'm doing tax policy at the federal, state, and local level at the Institute on Taxation and Economic Policy, and would love to talk to you about any of those three. So.
Okay, well, let's start at the federal level. Obviously, we can get back to state and local. So I was going to give you a very open-ended question. You've been there now, I guess, about 6 years. So what would you say, pick your three worst stories. What are the three most pernicious aspects of tax policy in the United States at present?
Yeah, I think one thing that I didn't even fully understand before I took this job was the degree to which we favor income from wealth over income from work. So, there just are these huge breaks for capital gains that prevent us from raising adequate revenue and that favor wealth over work. And who can imagine anything worse than that? As a person who had spent my career not entirely in tax policy, I'm really in labor policy, who would ever favor being more supportive of wealth and income from wealth than income from work? So I can talk a little bit more about all the ways that we favor capital gains, but that was one big one. A second big one is just corporate tax avoidance. It's just horrible. And, the Biden administration put forth some good policies and started to make a dent in it. But the Trump administration's willingness to actually break the law and not enforce what Congress passed under Biden has really harmed that. So we recently found that 88 profitable corporations paid zero taxes last year. And that's kind of that's a quick and easy finding that almost anyone can understand. But we also have a lot of findings that kind of go deeper on that. So I think those are two of the big things. And then just watching the influence of money on politics is really hard to see. And it takes place under leadership of both parties and with politicians from both parties or all three parties, I guess you could say, whatever, from across the political spectrum. You often see that just money talks in politics, and that isn't something that came as any surprise, after 20 years of working in Ohio. But it's no fun to watch it up close.
Well, that's a good start. All right, well, let's start with the discrepancy, the difference in taxation on capital gains and ordinary income. Most people probably know this, but just to give the basic story, the maximum tax rate on capital gains is 20%. Ordinary income for high income persons, 37%. So by getting your income classified as capital gains, you're looking at 20% rather than 37%. And you have a lot of 37%, of course, the top bracket, but you have a lot of very middle income people, their marginal tax rate's 25%. So you could have someone who's a firefighter, school teacher, whatever. They could be paying tax at a higher rate than Elon Musk or whoever, because all their income or almost all their income is going to be capital gains, at least most of the time. So that's, that's at least one story. I'm sure you have much more in the discrepancies between taxation on wealth and ordinary income, wage income, labor income.
Yeah, absolutely. So that's one of them, is just the difference in rates, like even if a capital gain is realized. But another one is just like until you realize that capital gain, it's not taxed at all. And so if you're Elon Musk, you don't ever have to sell your stock. You can borrow and live off of, you can borrow off of the sort of assets that you hold and buy whatever you want. And
did you know they did that before the leak? I did not. I mean, it occurred to me logically. If you'd asked me, could you do that? I would have said, yeah, but I didn't realize they actually did that until, I'm forgetting the name of the person. We should know them because to my mind, it's somewhat of a hero who leaked the tax return. I mean, no, it was against the law. I shouldn't have done that, but it was important for us to know it. I'm sorry. Go ahead on that.
Yeah. No, so that one was very, very surprising to me when I realized it. And then in addition, so then if you do realize those gains, you pay a lower rate. And then if you never realize those gains in your lifetime, you pass on that income tax-free to your kids and they inherit it at the new value, and nobody ever pays anything on the growth in income between what you bought it for and what your kids inherited it at. And I kind of had no real understanding of before I took this job. And it's really just it's a pretty outrageous kind of set of exemptions that really only helps moneyed people. So yeah,
let's take that last one because I think it just to drive it home for some people, of course, are very much on top of it, but it is an incredible story. So let's say someone put $1 million into NVIDIA, I don't know, 10 years ago. Today it'd probably be worth $1 billion. I don't follow that closely. It's going up a huge amount. So you've made 999 million on your NVIDIA stock. Now, if I were the person who did that, I'd be very rich, probably doing something else right now, but whatever. If I'd made my 999 million and sold it, I'd at least pay the 20% capital gains tax, but pass it on to my heirs. They get their $1 billion. We could talk about the estate tax, but they get their $1 billion and they never pay a penny of capital gains tax.
Yeah.
At least not if they were to sell it at $1 billion. If it goes to 2 billion, then they'll have to pay $1 billion on their capital gains, but they never have to pay capital gains tax on my capital gains, which is incredible.
Yeah, totally incredible. So yeah, and the funny thing about these things is they get talked about, or like you mentioned, the estate tax, it gets fought on these completely false bases, like somehow the estate tax is going to hurt the family farmer, except nobody has ever found the family farmer that it's going to hurt. So there are these very false narratives that are put forth. These are things that really have contributed enormously to the incredible growth in inequality that we see as a country. And, tax policy is like one of the best tools that we have to rein in inequality. You've done a lot on unionization in your career, and, unions are another one of the tools we have. Education's a third one. But tax policy is one of the tools we have, and we just really haven't deployed it to actually do something about inequality. in a meaning.
The debate on estate tax, as you say, it's really been kind of incredible. You obviously know David K. Johnston. Wrote for the New York Times for many years, a Pulitzer Prize winning reporter. He's still writing, and not going into David, great reporter though. But anyhow, I'll never forget this. Back, George W. Bush had this plan to get rid of the estate tax altogether. He hugely rolled it back, reduced the rate, and hugely increased the amount that was exempt. This is back, I think, in 2002, 2001, maybe, when the debate was. Anyhow, one of the stories, as you say, was that, it's hitting all these family farmers and small businesses. They already had all these provisions that made, allowed you to, I think it was over 20 years. If you had a family farm, you could pay it out over 20 years at basically like zero or very low interest. If you really wanted to keep your farm, it's pretty hard to believe that you wouldn't be able to do so. But anyhow, David called the Farm Bureau, which was big advocating, get rid of the estate tax because of the family farm. And he said, reasonable question, can you put me in touch with some of the people that lost their farm? Their family lost their farm because of the estate tax. And they said, well, we don't know of anyone. And, and he just goes, you mean in the whole country? You can't. And they said, well, we're sure there are people out there.
Yeah, no, it's a completely invented kind of, straw man or whatever the correct phrase is. So it's pretty absurd. And, the exemptions are huge, are enormous, and have grown under Trump tax policy. But the exemptions are almost only a kind of sidebar to the story, because the truth is that really moneyed people can put their money in trusts and find all these ways around even the ridiculously high exemptions. So, and everybody thinks, we're not going to get mom's house if we do something to reform the estate tax. That's not even remotely possible. There's always these cutoffs that leave kind of the wealth that middle-class people might be passing along, or even upper middle-class people might be passing along, out of the equation.
Yeah, there are 2 points of that I think a lot of people miss. One is again, I think people are very unaware of the floors, how high they are. The second one is, you've encountered this, we've all encountered this, the confusion on marginal taxation. So I think we're now at 10 million for the cutoff for the floor on the estate tax that I don't have 10 million, but if I had 10 million, I could pass on 10 million without having to pay the estate tax. Is that it? It's something like
I thought, actually, sorry, I don't have this number right in front of me, but I think it's higher than that.
Okay, so it's some very high amount, but let's hypothesize. I remember back in the Bush days, it was 1 million. So we'll go, the good old days when it was just 1 million. So people were saying, that could be a middle-class person could have, an estate of, and this was a quarter century ago, so make it 2 million today, whatever. So they could have an estate of $2,050,000 and they'd have to pay the estate tax. But the point was you only had to pay the tax on the amount over it. So you had to pay the tax on 50,000. So I get it. No one wants to pay taxes. I get that. But you're paying taxes on 50,000. You're not paying taxes on 2,050,000. So in the unusual case where an upper middle class person actually crossed into it. And I'm sorry, now, no, you're an upper middle class if you have 10 million or 11, whatever the current numbers. That's not upper middle class. That's rich. But, back in the old days, you could say upper middle class. Okay, if by some chance you happen to just cross over that, you paid some trivial amount of the estate tax. You don't want to pay it. I understand that. But, can't tell me if you're inheriting $2,050,000, you can't pay $10,000 in taxes or whatever. That's just nuts. So.
No, I mean, in 2018, they found that only 1,800 estates nationwide would be subject to the estate tax at all. So that's like 0.06% of the deaths that year would be subject to the estate tax. So it's kind of a meaningless thing. Yeah. So getting back, so capital gains, I think that's one of the biggest outrages. I think the second thing I talked about was corporate taxation.
Before we get to corporate taxes, because I do want to make one more point. You're probably familiar with this. If not, you should be. When Reagan passed the 86 tax reform, they equalized the tax rate on capital gains and ordinary income. It's 28% was the top bracket, which is too low. I mean, I would have liked to see it be considerably higher, but it was a great thing in the sense that he gave this speech where he said, now people will make money by investing and working, not by trying to game the tax code. And that's exactly what you're encouraging when you have a capital gains tax at 20% and ordinary income at 37%. Guess what? You have smart accountants who are going to make all your ordinary income look like capital gains. And that's exactly what they do.
Right. Right. And that's why, a lot of these, a lot of very wealthy people and CEOs will take all of their compensation in the form of stock or, and keep their actual earned income extremely low so that they're paying almost nothing in taxes. And Jeff Bezos famously does that, but, a lot of them do it. And that was a fine moment in the Reagan administration, was like this recognition that his first round of tax cuts had really created some very problematic issues. And he didn't really fix them entirely because he didn't he didn't kind of put in place higher rates, but he did do some reining in because he just realized there were ways to kind of realign things that would work better. And of course it only lasted, I think, until George H.W. Bush, right?
Yeah. And Clinton made it worse. So
right.
Anyhow, okay, corporate taxes. I'm sorry.
Yeah, well, just so we found that 88 profitable corporations paid zero taxes in 2025. That's like higher than what we have found in Biden used to talk about 55 profitable corporations. And he had that statistic was kind of at the source of passing this corporate alternative minimum tax that was part of, what was once called Build Back Better, that eventually was called the Inflation Reduction Act. And the corporate minimum tax was one of the best provisions in that. And, a bunch of corporations in 2024 said, we're going to have to pay more because of this corporate minimum tax. And the Trump administration pushed through a really awful tax bill that gives $1 trillion to the top 1% over the next decade. But they couldn't actually get united around getting rid of the corporate minimum tax because Americans like the idea that hugely profitable corporations ought to pay something in taxes. So they couldn't get rid of that in Congress. But what's happened is that the Trump administration has just defied the will of Congress and not enforced that part of the code and sort of written the rules in ways that enable people to get around it, enable corporations to get around it. So we now find 88 corporations paying zero. And people can go to our website at itep.org. We now got this corporate tax avoidance tracker that's really cool. And that kind of tells you, on a daily basis, as corporations file their tax forms from last year, how many of them are avoiding how much in taxes. But yeah, they avoid a lot of taxes.
That's it's great you guys are doing that, and it's important to name and shame. One of the things, if you go back now to ancient history, in Trump's first term, they lowered the corporate tax rate, of course, from 35% to 21%. They originally were talking about 17, but in any case, they decided 21%. And I wasn't totally unsympathetic to that, at least in principle, because the line was that in reality, almost no companies paid 35% in taxes because they had all these various ways, dodges. So if you lowered the tax rate, and again, my number would not have been 21%, but if you lowered the tax rate and made it much more difficult to get loopholes, in other words, they actually paid the 21%, I would have had a higher number. But the idea of lowering the rate and actually collecting it, to my view, makes a lot of sense, because you don't want them to spend money. It's a waste for them, for the economy. You want to say, here's what we want to collect. And again, it should be a higher number than 21% in my view, but you want to have it so that's actually what the tax rate is. And we quickly saw, no, that was not what the tax rate is. And they made it much worse. In other words, the loopholes were all still there, and even worse now, because as you say, they basically look the other way when it comes to enforcement.
Yeah. I mean, so one of the things that like tax experts are, kind of across some share of the political spectrum, are often for lowering rates and closing loopholes and, having it actually collected. And yeah, like you, if you could show me that you get the same amount of revenue with a slightly lower rate and it's kind of reduces some of the gaming, I'd be for it. But what we actually find in reality is that corporations didn't pay the old rate and they don't pay the 21% rate now. Our little corporate tax tracker that people can find at ITEP.org finds that 303 companies have so far avoided, I think it's 146 billion in taxes on over $1 trillion in profits just on their 2025 returns. And this is kind of this ticker that's updating all the time. And that only actually gets at some of the issues in the corporate tax code, because there are other issues with corporate taxes that aren't even captured by numbers like this. Like, for example, a huge share of American companies now are labeled as pass-through companies, and they get a big tax break for being pass-through corporations. And, that has grown exponentially. It's much higher here than in other countries. So it's like a technical, sort of hard to explain thing.
Well,
But
let's explain, because I think it's important. Well, only rich people do it. So I shouldn't say a lot of people do it, but a lot of rich people do it. It's important to understand. Do you want to explain for a moment just what a pass-through corporation is?
yeah, so a pass-through corporation used to be reserved for sort of what we think of as small businesses. And that was the idea behind having it. Like, just that you would pass through the taxation onto their individual income tax, and they'd pay the individual income tax rate on the income that came from the corporation. But over time, more and more and more companies began to be categorized as pass-through entities. So it's now a lot of law firms, a lot of accounting firms. The Trump, what's he call it? The Trump Corporation, or the Trump Enterprises, whatever. Trump
Trump Enterprise. Yeah.
is a pass-through.
I thought he created a new category called Trump. Anyhow, sorry.
Yeah. No. His own individual real estate and other empire. They're all categorized as pass-throughs. And the problem with pass-throughs is that they don't have the same reporting requirements, and they don't pay the corporate rate, and they're extremely difficult to audit. And that's why Trump has been able to get away with paying such low taxes for so long. It's very, very hard for the IRS to understand what's going on. They're not required to disclose enough information, and the IRS doesn't have the capacity to hire people with the depth and time and expertise to dig into it. And so it means a huge amount of revenue that American people are losing, that could be used to purchase universal health care for every American, that could be used to make sure that every working class kid could afford college, that could be used to make sure we have childcare for every working parent. No, instead it's kind of hidden in these pass-through corporations.
I'm kind of a hard ass on this. I did a little homework on this a little while back because I was wondering what the origins. I think it goes back to the early 50s that you first had them. And to my view, I mean, this is a great case where the libertarians are never on it. I mean, I've met some honest libertarians, I was going to say, but I know a lot of people call themselves libertarians. And I always go, okay, so you're against corporations. And then they look at me blank-faced. I go, Amy and I have a partnership. We work together and we split our, profits. However, but to have a corporation, that's something created by the government. So it's a separate legal entity. And that's, to my view, the logic of the corporate income tax. If you want to have a separate legal entity that acts on its own behalf, and by the way, can go bankrupt and tell all its creditors, you're out of luck. They can't come after me and Amy. They go after the corporation. They don't have any money. Well, it's your problem. Okay, so if you create a separate legal entity, to my view, well, that legal entity has to pay the corporate income tax. I don't think there's any basis for an exception to that. So that's where I would have been. I understand we're very, very far from that. But, to my view, that's just an incredible tax break that goes overwhelmingly to rich people. I mean, there probably are a few more middle income types, but that's overwhelmingly going to, the very top end. And yeah, to my view.
Exactly. It's hugely increasing inequality, and corporate taxation too. I mean, people often want to kind of raise questions about who benefits from a corporate tax cut. Well, that analysis has been done, and the main entity benefiting from a corporate tax cut is corporate stockholders. And the main people who own corporate stock are very, very wealthy people. And, again, there's this ability to kind of manipulate the American people to thinking, oh, I've got a little bit socked away in a 403B or a 401k account, and therefore I'm going to really suffer if we tax corporations. No, it's the vast majority of the benefits of a corporate tax cut, first of all, go to foreign investors. And then the next biggest category is, the top 5%, the top 1%, the top 5%. And very little of it goes to middle income people. And, from a racial perspective, it's almost overwhelmingly wealthy white people who see the benefits from a corporate tax cut. Black and Latino families together each get 1% of any corporate tax cut, because that's how little corporate stock is owned by regular people in this country.
Yeah, with, because we just tested this, usually don't want to test, abstract economic theories, for the whole country. But, we did literally just test this back in 2017 with Trump's first tax cut. And I knew Kevin Hassett, I'll say friendly. I don't know if we're accurate to call us friends, but, we could talk to each other. We'd have discussions on things.
You can talk to anyone, Dean.
Yeah. And anyhow, he was a true believer. He really did, because this was before he was in the Trump administration, years before. He done research. I think it was flawed research, but that most of the benefits of a tax cut, a corporate tax cut, would go to workers in the form of higher wages. Well, he got to test that, and it wasn't true. I mean, you could beat up the data, and maybe you could find some small wage benefit, but I know the data, and again, I know how to play games with data. You'd really have to beat it up to show any non-trivial portion of the benefits of that tax cut went to workers. So
yeah.
exactly,
we saw the stock buybacks that took place right after the passage of that bill.
Yeah. And there was the story would be, if I had Kevin here, he'd say, oh, there'll be a big boom in investment and that will increase productivity, it'll increase wages. There was no boom in investment, so it all falls apart. If you don't have the boom in investment, nothing else is going to happen. There was no boom in investment. So you lost, he lost, we lost because they did it. But yeah, so.
Yeah. And I think that, the interesting thing about all this is that a lot of it's just really obscure to regular people. It's complicated. I spent a whole lifetime kind of working on labor policy, and labor policy is very intuitive to me. Like, it's very clear to me what's going to help working people and what's not going to help working people. Sometimes I get it wrong, but most of the time it's just like you present me with an idea or a policy or a corporate behavior, and I'm like, yeah, that would help workers or that wouldn't. Tax policy is much more obscure, and if you haven't been reading the business pages for your whole career, you're easily kind of thrown off the trail by all these acronyms and all these assertions by the Kevin Hassetts of the world that, oh, no, it looks like a corporate tax break, but really it's going to help the workers. And you think, oh, is it? Well, I don't want to be the one advocating for something that's going to hurt the workers. I think that's all very intentional. It's a way of keeping regular people out of having a voice in these policies, and it's a way of obscuring who really is helped. But we can just look at the growth in inequality in this country and know that whether it's labor policy or regulatory policy or tax policy, we're simply not doing enough to make sure that everybody benefits from the growth in our economy.
That is such an incredibly important point, that you do get into these obscure things. So earlier we were talking about pass-through corporations. I'm a nerd, you're a nerd on this stuff, but we could probably find very educated people, go to people in law school and, read the newspapers, and I'll bet half of them would not have the faintest idea of what a pass-through corporation is. Like, I'll pick on my brother, who's a lawyer, also has a PhD in sociology. I'll bet he has no idea he might end up seeing this. So he'll give me shit if he does. But, but it's not something you come across in your daily life. And that's exactly what they want, because that means the only people engaged in it are basically the people on their payroll, and they're going to win that.
Right. And, it actually comes back to what you were saying about graduated rates. And you were talking about it, I think you were talking about it in relation to capital gains or inheritance, the estate tax, I guess. But, that applies to just regular state level income taxes or federal income taxes. People kind of think you're going to pay the top rate on your full income. Well, if there's a rate bump at $100,000 and you earn $101,000, you're only paying that higher rate on $1,000 out of that $101,000. And I think people really don't understand that, even though it's very, very, very basic part of our tax code. But it's not, it's a little hard to follow unless you're really paying attention to it.
And I'm going to beat up on the media, which is one of my pet things to do, but favorite things to do. But I remember years ago, President Obama said, well, we're not going to raise taxes on anyone who makes less than $400,000. Now, to me, this is some years ago, so that'd be like $600,000 a day, but whatever. Even back then, $400,000 struck me as you're pretty wealthy. Yeah, I mean, you aren't rich, obviously, but you're doing pretty well. So it wouldn't mind me if you said 200,000. But in any case, I remember the Washington Post had a front page piece, asking, is 400,000 really rich? And, they profiled some people who made, 430 or something. And they said, are they, and the gist of it was, well, they really can't afford a tax increase. Again, it's exactly this marginal issue that you're not going to be paying higher taxes on the 430. You're going to be paying higher taxes on the 30.
Right.
And again, I get they don't want to pay higher taxes, but if someone making 430,000, are they going to be corrupted if they have to pay another 2,000 a year in taxes? To my mind, that's ludicrous. They might see it
It's
different.
ludicrous. And you moved from DC to you're in Montana, right?
I was in
Yeah,
Utah.
you're very hard to keep track of. But, I think that that's where we also see just the huge disparity in incomes, in some of in a place like Washington, where a lot of the decisions are being made, and in the rest of the country. So, $430,000 is extremely wealthy. It's an extremely high income level compared to almost anyone in the country. And yet what happens is that the kind of commentariat class all earns with maybe, may earn within striking distance of that, or they have neighbors or they know people who earn that kind of money. And so they think it is pretty hard to afford a house in, Manhattan or, in Georgetown on a more modest salary. But in most of the country, that's a very, very high income. And so we just have to kind of keep it in perspective, right? And as you say, if a rate goes up, it's only on a teeny little portion of that income. But something like that $400,000 pledge was problematic because in order to actually fulfill that pledge, you had to leave a lot of things off the table that might have raised taxes just a little bit on somebody who earned, a family who earned $385,000. It's not a great way to think about tax policy.
Yeah, no, it wouldn't have been my guiding light either. I mean, maybe it was good. I'm sure it was. I'm sure it was focus group tested, so that was why they did it. But it was not good from a policy standpoint.
Yeah.
Well, let's take a few minutes. I sing praises to Biden. I have plenty of things to criticize President Biden for, but what would you say are the positive things? You've made some references to some of the things his tax proposals, some of which got through and most of which didn't. But what would you say were positive about what he tried to do and succeeded in some cases in changing the tax code during his term in office?
Yeah. Well, he passed increases to refundable tax credits that like the child tax credit that really eliminated child poverty. Really. It made a huge difference for low-income children in this country. So that was a huge, huge positive. And it didn't really end up fully paying off for him because he couldn't sustain it in the second half of his term. And therefore, people perceived that they'd kind of gotten this break and then it went away. And, it's very hard for a person who's working and trying to raise kids to sort of follow all the ins and outs of what happened and why did it happen and who voted against what in the 50-50 Senate. All they know is they were getting a benefit and it went away. But it was a great boon to equity, raised the incomes at the bottom. It got rid of a lot of child poverty, and it was a really important investment in people.
Yeah, that's a really I hadn't forgotten about it. I hadn't thought about it for a while, but it really made a huge difference to low and moderate income people. And I'm forgetting how much it came to, an extra 1,000 per kid, 2,000 kid.
Yeah, I'm really bad at remembering numbers.
The total cost of it was something like $30 billion a year, which is, we have a war going on. It's going to be trivial compared to that cost of that war. And It made a huge difference in the lives of tens of millions of people. And this is, if I talk about unforced errors of the Biden administration, because obviously they had to fight to get things through Congress, but when they had their original recovery package they passed in February, just after it took office, February 2021, they had the money in there for just, I guess it would have been a year and a half through 2022, and then it went away. And their working assumption was that, well, people would like it and they would be able to continue it. But what happened was that you had to deal with Manchin in the Senate. Reason for picking on Manchin, because he was the deciding vote. You needed all 50 Democrats, and he refused to do it. He said, "Oh, people are using it for drugs and whatever." I mean, it's crazy stuff. We knew. I don't know what he knew, but I mean, there was research. They were not using it. Anyhow, so he didn't get through. But that was something that was relatively low cost, made a huge difference in people's lives, and yeah, it's just the I just wrote a piece I wasn't really trashing universal basic income. I was just making the point. You have people advocating that and go, we couldn't get a damn child tax credit through. How are you going to get any sort of serious universal basic income? I mean, is it a good idea? Sure. But, in this political realm, anyhow, I'm sorry, long distraction.
Yeah, no. And then I mentioned earlier the corporate minimum tax that passed as part of the IRA. And that was, that was a great policy. I mean, there might have been other ways of going about it that the tax wonks on my staff might have liked better. But it just basically said, you can, if you're $1 billion corporation, you can use other kinds of loopholes, use all the loopholes you want. But at the end of putting in place all your loopholes, if you're paying less than 15%, you got to top up to get to 15% tax rate. As you said, the rate is actually 21%. So you can take a bunch of loopholes and get down to 15, but you can't go below that. And that made a lot of sense to a lot of people, including Joe Manchin. And that did make it through. And it was set to raise a lot of revenue. And it still is raising revenue, even after the Trump administration got its own, next whack at the tax code. But it's raising less than it could because of the way that the Trump administration is violating the law. But it's a very important principle that most Americans really feel extremely strongly about. Huge profitable corporations should not be paying almost nothing in taxes. So that was a big win.
One more that I'll throw in, I assume you'd feel similarly about. I was a big fan of the tax on stock buybacks. There was a 1% tax, a very small tax, obviously. You can make it much larger. But I was a big fan of that because it's one that's very hard to get around. So, you're announcing, I've been pushing this idea for some time that, if we just basically gave the government a share of corporations, a non-voting share. So I won't mind being called a communist, but in any case, this would be a non-voting share. So, whatever tax we're looking for, 20%, 25%, they get 25% of the shares. If the corporation buys back shares at $100 each, they pay the government $100 for each of its shares. If they pay a dividend of, $10 a share, then the government gets, so there'd be no way to avoid your taxes because, unless you're ripping off your shareholders, which maybe you are, but then who are you doing it for? So anyhow, I just thought the share buyback was such a great tool that way because they can't very well buy back shares secretly. If you're a big company and you're spending $1 billion buying back shares, your shareholders are going to know it. And if your shareholders know it, well, presumably the IRS knows it. So we know to get the money. So I was a big fan of that.
Yeah, no, and I mean, I think one of the things about that is interesting is it kind of reinforces how you want to have a big menu of options because you just don't always know what's going to make it through the policymaking process. And a lot of it gets slashed at the last minute, and then something new gets jumped on at the last minute. So Kristen Sinema was, I think, against something that was that her hedge fund funder, her hedge fund campaign donors didn't like. And so everybody thought that was going to be part of the package. And at the last minute, she wouldn't support it. But then they were able to pull this other thing out and somehow get it past her. And, so that speaks to like what I said was the third thing was just the influence of money from a negative perspective or from a positive perspective. Look, there are so many things we could do to make our tax code better at the federal and state and local level. So have a big agenda, have a bunch of possibilities out there and, be ready to kind of pounce on what seems likely to get through that narrow policy window.
In terms of the influence of money, and one that will always stick with me, the carried interest tax deduction. I first heard about this about 20 years ago, thereabout. And someone telling me, and he wasn't an economist, not that you have to be a genius to be an economist or something, but I thought he was confused because it just sounds so crazy to me. So people are not familiar with it. Carried interest tax deduction almost exclusively goes to rich people. So this is like partners in a private equity company, a hedge fund, real estate investment trust. They get paid, they have people put money with them. They control tens of millions, hundreds of billions in some case. Their typical contract is they get, let's say 2% of whatever's invested with them. So if they have $1 billion invested with them, they're getting 20 million a year off the top. That goes right to them. And then they get a share of their earnings, usually above a threshold. So if they beat the S&P by, whatever, then they get a share of that. Again, I'm picking, they could have any threshold. Let's say that's a threshold. And what they get over that threshold is what's called the carried interest. And instead of paying normal income, instead of that being taxed as normal income, that's capital gains income. I'm going like, how is that capital gains? I mean, you have a car dealer, they're paid on a commission. If they sell you a car for, $30,000, they get 5%. I don't know what the commissions are, but whatever, they get some share of it. A realtor, it's not uncommon for people to be paid on commission, or at least on part on commission. That's all taxed as normal income. But why on earth, when you have a private equity guy, and these are, some are women, most are men, whatever. These are the richest people in the country, many of them. They pay lower tax because they're calling it carried interest. When I first heard about this, as I said, this guy told me, and I thought, he doesn't understand. I looked it up and go, holy shit, he's right. So then I contacted a friend of mine who was a conservative economist. He's in the Bush administration. And, I asked him, what's the rationale for this? And he said, well, these are really powerful people. And, well, I know that, but I'm asking what the economic rationale is.
Right.
And he goes, there isn't one.
Yeah.
So he didn't even have a story, he was I consider relatively honest economist, but he's definitely, conservative economist. He was in the Bush administration, and he didn't even try to tell me a story. It just, right. They're powerful people.
Yeah. Yeah. No, it's really pretty outrageous. And, and as it also kind of reinforces what I said earlier about it's kind of intentionally obscure, right? It's a little hard to follow. You're pretty good at explaining things, but it's like, could I take your explanation and tell it to someone at a cocktail party? I'd have to read it and write about it a couple times myself before I'd internalize it enough to talk about it. And that's part of what I think these money and interest really trade on in our tax code.
Yeah. No, exactly. And that's an incredibly strong argument for simplicity, and again, going back to, the original, not that was ever their idea, but, kind of our glorified idea. If we ever want to give Trump credit for anything, okay, lower rates, get rid of the deductions. That would be fantastic. But their plan was lower rates, keep the deductions.
Exactly. I forgot the second very important part.
Yeah. So, all right. Well, we covered everything on tax. Let me ask, are there issues, any big issues that we left off the table that you really want?
Well, I just would say it's really important to recognize that the One Big Beautiful Bill Act, or OBA, Trump's second term big tax cut, really, goes overwhelmingly to the wealthy, $1 trillion to the top 1% over the next decade. Really, and does that by cutting healthcare for regular people and by adding a huge amount to the debt and deficit, which, isn't normally my biggest issue. But, there is a point where it's like we're paying interest on the debt and we're not paying for childcare, we're not paying for healthcare, we're not making college affordable. And now you've got, of course, this war added on to the credit card. So I just think it's really important for people to realize that the second term Trump tax cut represented a shift from high income people paying taxes to lower income and middle income people paying taxes in the form of tariffs. And it represented a shift from the health care that regular people needed under both Obamacare and Medicaid, to enrich the wealthiest. So it's the legacy that this purportedly populist candidate has left is just really deepening inequality in this country and really hacking away at our already limited social contract that we delivered to most people. So, I hope people will really understand that and internalize it when they're thinking about what do we want from the next set of leaders in this country.
Well, thanks, Amy. That's a good way to end it, and hopefully we'll have the next set in before too long. Thanks a lot, Amy Hanauer. Thanks for joining us.
Great talking to you, Dean. Take care.
If you like what you just saw, please help us out by liking us and subscribing. Thank you.